Greetings everyone and welcome to the webinar series of Advith. I am Srilata, a chartered accountant and working with Advith in the team of knowledge and solutions. And I have with me CA Krishna Upadhyay sir, co-founder of Advith iTech Private Limited. Welcome to you sir for today's session.
Thank you, Srilata. Good evening.
Good evening. So yeah, this is our third webinar session on the series NRI Guide to India Property Transactions. In our previous two webinars, we had covered various aspects from understanding layer to practical impacts on selling and buying of India properties as an NRI. If you had missed attending it on live, you can watch recorded ones on our YouTube channel. As a continuation of our ongoing series, which is on NRI Guide to India Property Transactions, today we are going to cover repatriation essentials every NRI must know. In our previous session on buying property in India, we did touch upon repatriation aspects at certain relevant points in the context of funding, FEMA regulations, account structures like NRO, NRE accounts, and so on. However, in today's session, we are going to give focused and in-depth coverage to repatriation, especially from a planning and execution perspective, so that NRIs have clarity much before they enter into a transaction. It's critical because one needs to understand that repatriation is not just a post-sale banking formality. Rather, it's a regulatory outcome that is decided at the planning stage itself. Hence, it becomes important to know about repatriation framework, account structures, FEMA conditions, and documentation requirements as an NRI. Before proceeding to repatriation aspects, first let us briefly understand the types of accounts that are relevant for our today's discussion. So they are NRO, NRE, and FCNR accounts. NRO, non-resident ordinary account, is primarily used to manage income that arises in India. It could be your rental income, sale proceeds of property, pension, or other India-sourced earnings. And it can be funded through Indian income transfers from other NRO accounts or permitted inward remittances. So next we have NRE account, which is non-resident external account, and it is meant for parking foreign income in India. It's maintained in INR and is generally funded through foreign inward remittances or transfers from other NRE or FCNR accounts, and is commonly used for investments and property purchases in India. Next, we have FCNR accounts, foreign currency non-resident account. It's a FD account maintained in foreign currency, and it is designed for NRIs who wish to hold their overseas funds in India, but without taking exchange rate risk. And it can be generally funded through foreign remittances or other NRE accounts. With this brief context on account structures, I would request Krishna sir to highlight more key differentiation aspects in account structure from especially from FEMA and taxation standpoints. Over to you, sir.
Yeah. So one important thing that one has to understand is that all that we are talking about are for individuals. These are for non-resident individuals and the different kinds of accounts that they can maintain in India. Now, like we mentioned in one of our previous webinars also, India is one of those countries where foreign currency transactions, foreign currency regulations are highly regulated. The Central Bank of India regulates the kind of transactions that can take place, and similarly also regulates the kind of accounts that one can maintain and operate. So going by that, the foreign exchange management law, including the Act, rules, circulars, regulations, etc., designate the different kinds of bank accounts that one can open in India. And those are the only permitted accounts that could be held by non-residents. So like Srilata mentioned, the three of them, the non-resident ordinary, external, and the FCNR accounts. Let's assume you have rental incomes in India. There's a property that has been let out. Your tenant has to remit the money on a month-on-month basis to you. They can put that amount into your non-resident ordinary account. You could also allow that account to be operated by one of your relatives in India. Let's say your parents are based out of India, and then they have to be taken care of. In such situation, what happens is that you could allow them to use that account, or you could also make sure that the monies that are debited into that account, that is the money that is moving out from that account, are going to them. So these are typically, therefore, like Srilata mentioned, are used for getting India incomes as well as taking care of the expenses that you may have in India. This could even be expenses that you have when you visit India. You want to, spend for your stay here or your travel here and all of that. NRO accounts comes in handy. These are like any other savings bank account that a Indian resident has, but will get designated as a non-resident ordinary account the moment somebody goes out of India with an intention to permanently or near permanently shift outside India, either by taking a employment outside India, starting a business outside India. Those who are going for a temporary reason, travel, short duration, need not get their accounts redesignated. However, the ones that are going out of India for employment purposes or business purposes or even just lifestyle purposes outside India, then it is mandatory for the bankers to designate their those accounts from being resident accounts to non-resident accounts. It is also therefore the obligation of that person to inform the banker that they are hitherto who were residents henceforth will be non-residents, and therefore the accounts can get designated as non-resident accounts, and the normal SB account will therefore get converted into a NRO account. India also permits ensuring that there is an account which is like a hybrid between the two kinds of accounts. That is, ordinary account within India and a foreign account, something in between. If somebody wants to maintain, and if they wish to maintain those account in Indian currency, Indian rupee, then they are allowed to open and maintain a non-resident external account. The non-resident external account are akin to foreign accounts. They are on par with foreign accounts, and therefore, the stringency of regulations are more. We will talk about that a little further in this webinar. These are accounts which are like, INR accounts. Permitted credits into these accounts are, let's say you have a foreign sourced income, you wish to bring that and park it in your NRE account for multiple reasons. You may be eventually thinking of coming back to India. You may be unsure if you want to park some money, in foreign country because you have a surplus. You don't wish to invest there. There is political instability in that country. There could be multiple reasons why you may want to, put that money in non-resident external accounts in India. And the important part is Indian accounts, as most of you may be aware, gives you an interest. A lot of countries, developed countries in particular, where the inflation rates are substantially low, and advanced financial disciplined countries, the banks don't give interests or returns on the monies which are parked. So that becomes a critical decision making factor also to park some surplus funds in INR designated non-resident external accounts. FCNR accounts are again foreign currency accounts. Instead of maintaining it in NRE accounts, you could maintain it in FCNR accounts. In case you earn interest on your non-resident ordinary accounts, such interests are taxable in India. There's no exemption on that. But if you have money in your NRE accounts, the interest that you earn on those accounts are exempt from taxation in India. And these accounts, the NRO, NRE accounts, can be in the form of savings bank account or in the form of deposit account as well. That is in the form of term deposits as well. In both of these kind of accounts, whatever interest is earned on the NRO deposits, NRO savings bank accounts are taxable in India, and none of the DTAs also give relief on that. There are some reliefs that are there in terms of the rates of tax. Some DTAAs double tax avoidance agreements have reduced rate of tax for a non-resident on incomes earned in India. However, they are essentially taxable in India. It's not that there is any exemption. As far as non-resident external account interests are concerned, they are not taxable in India and they are exempt from taxation in India. So based on the need of maintaining the money and its usage, one has to be very careful in ensuring that the right kind of account is opened by them.
Yeah. Thank you, sir. I think with this, we have got a stronger context for today's session. As we have covered, there is some clarity coming on nature of accounts. So with this, I think we can move forward to understand how repatriation works through different accounts. Because under FEMA, if you see, repatriation is not treated uniformly. It depends on the account involved, the nature of the transaction, and compliance with prescribed conditions and limitations. In the case of sale of property by an NRI, if you take as an instance, the sale proceeds are considered freely repatriable only if three key conditions are satisfied. First, the property was originally acquired using NRE or FCNR funds or through direct inward remittance. Second, the repatriation relates to not more than two residential properties. That means free repatriation facilities available only up to two residential properties and not for the third one. And the third condition is all applicable taxes have been duly paid and FEMA compliance at the acquisition stage itself has been established. If these three conditions are not met, repatriation must be routed through the NRO account. And when it comes to NRO account, it becomes subject to annual limits along with procedural requirements. So with this, so can you provide additional insights on repatriation, especially considering practical aspects and how things happen on a day-to-day basis?
Yeah, absolutely. So, like I mentioned earlier, India is one of those countries where foreign exchange is strictly monitored, and therefore, something which is repatriable and not repatriable are very clearly defined and highly regulated. What does repatriation mean? Repatriation, in simple terms, mean that what amounts are allowed to be going out of India, what amounts are not allowed to be going out of India. Now, what are the practical possibilities? The practical possibilities are the following. Let's assume I am a non-resident. I stay outside India. I have property and let's assume deposits in India. All of them are earning me incomes. The property is giving me a rent and the deposit is giving me an interest. I want to move this out of India. This is, let's say, one possibility. The second possibility is that let's assume I'm a non-resident, my parents are resident, they reside in India and I reside outside India. They sold a property. They may want to give that money to me as a gift. Is a second possibility. Third, I myself might own a property which I wish to sell. I might be owning some shares that I hold in Indian company that I'm selling. I'm a startup founder residing outside India, but my startup is in India. I'm selling those shares, and money is coming out of that. So these are probably some of the different possibilities in which I have monies in India, and I want to move them outside India. The general rule are the following. Number one, there is something called as the liberalized remittance scheme. What the foreign exchange management law says is that uh, as a person, either me myself transferring money from my account in India to outside India is restricted to a maximum of $250,000 US dollar equivalent to 2,50,000. That's the maximum I am allowed to transfer from my own accounts in India to outside India. Now, what will happen is that the same limits also apply in cases where my parents, let's say they might have had pension income, they might have had a income from selling a property that they have and they wish to give it to me. Even for them, the limit is 250K. So they also can transfer a maximum of 250K in a financial year. Financial year in India is clear, April to March. So in that year, what can be transferred is a maximum of 250K. Now, the next interesting part is that let's imagine a situation whereby uh, I am a non-resident. I acquired a property when I was in India. I went outside. I became a non-resident. 5, 8, 10 years later, I decide to sell that property. Now, this property was not acquired in compliance with foreign exchange law because I bought this property when I was in India. This property is not a foreign currency asset. This property is not something that I acquired out of foreign currency. In such situation, the limits are different. Next, in case, let's assume I invested money from outside India to buy an asset, let's say a flat or a house or a land or any of those, and then I invested from outside India in that, and eventually I'm selling that. Then the limits are different. Shilata, would you want to highlight those conditions in which these limits are different at different points in time? The
Yeah.
three
So
conditions that you
basically,
mentioned, yeah.
yes, yes. So those three conditions would be helpful. So basically, if the funds are first condition is the property needs to be originally acquired using NRE or FCNR funds or through direct inward remittance. If this is satisfied, and then the second condition, the repatriation relates to not more than two residential properties. So for the first sale of property in India, for the second residential property sale in India, those proceeds can be freely repatriable, but not for the third one, third residential property. And it's a lifetime limitation. It is not like within 1 year, three properties or two properties. It is not like that. It's a lifetime limitation that up to two residential properties, this freely repatriation facility is available. Third condition is all applicable taxes have been duly paid and FEMA compliance at acquisition stage is established. This is what Sir just explained just now. All these three conditions should be simultaneously accomplished and satisfied to make sure that the funds are freely repatriable. Otherwise, no, it will have to go through those limits and then it can be repatriable outside India.
Okay. Now, let's take the scenario where the property was acquired when I was within India, and then these were not acquired out of my sources outside India, which is either from directly from remittances from outside India, FCNR accounts, or from NRE accounts. Then what happens? There is a $1 million limit that is fixed under the foreign exchange law, whereby whatever may be the proceeds of my sale of a particular property, the limit is a maximum of $1 million. Now, we put three things in front of you. So let me bifurcate them into right contexts. Point number one, if there is a sale of a immovable property, not more than two houses, lifetime limit, and the proceeds out of that are coming, and I have paid due taxes in India, irrespective of the value, I can repatriate that entire money. So there is no value restriction on that.
Yes.
Second condition or second situation is that I have not bought this property from sources outside India. Either I might have inherited this property or purchased this property when I was within India. I sold the property, then the limit is a $1 million limit. I can, within a particular financial year, I can only remit $1 million. In the next year, I can remit the difference. Let's imagine I sold a property for $3 million, roughly about 28, 30 crores. So then what happens is that I am only allowed to repatriate it over a period of 2 to 3 years. Of course, there is an option to apply to the Reserve Bank of India and get this relaxation to repatriate higher. But practically, Reserve Bank of India allows that in extreme situations where there is a health condition or something like that, which is extremely important, which is life threatening for somebody. In such situations, they allow, but in otherwise, they don't allow, and the limit is always $1 million. Other than that, if let's assume I am having rental incomes accumulated in my bank account in India from property that I own in India, or one of my parents deposited some money as a gift to me into that account. All that I can repatriate to a maximum of 250K in a particular financial year. Also, all of these remittances have to go through proper banking channels, and these bankers are called as AD bankers, authorized dealer bankers. They allow these remittances to happen, and that's how Reserve Bank of India keeps a check on all of these. Now, what are the documentation and other things that are required in this? The bankers determine firstly as to how do you have to prove to them that what is the source, was this repatriable source, non-repatriable source, and all of that. So that is one important aspect that the bankers will question you, and you'll have to prove to them as to how did this money come into your bank account. Second, it is also important that the income tax law puts in a condition that the monies should have been tax suffered. Therefore, it also puts a condition that you'll have to get such certificates from a chartered accountant in India stating that these monies have been tax suffered, and if not tax suffered, you'll have to ensure that you prove that those are not taxable monies that were there. Let's assume somebody gifted you some money and that is there in your bank account, you're moving it out. In such situations, it has to be proven both to the chartered accountant certifying it, and likewise to the banker who's allowing that remittance. Basis that only repatriation of that money will be allowed. With all this documentation, one has to make sure that it is presented to the bankers, and the bankers will allow repatriation of those money based on the limits that are there. How does the 250K also determine? Typically, it is recommended as well as forced by bankers that you only have accounts in one bank when you're a non-resident. If you have multiple banks, and you'll have to designate one of them as your authorized dealer banker if you have more than one, and you'll have to do remittances only from one of those bank accounts.
Yes. So apart from these regulatory framework and compliance aspects that we just discussed on repatriation, it's equally important to look at how these rules play out in practice, because in real life, the gap is more in terms of certain misconceptions and lack of clarity at planning stage. It could be incorrect account selection, assumptions around free repatriability, or incomplete documentation. Sir, according to you, what are the practical challenges or complications involved at this stage? And can you provide some insights with pro tips so that NRIs can identify potential red flags early, uh, rather it can help them to avoid pitfalls while planning and executing repatriation? I think a few points we have highlighted in our flow, but a section separately dedicated so that it can really help NRIs in acting.
Yeah. Absolutely. So it's important to make sure that of course, life doesn't come with a very planned structure, and the money that you may need, whether in India or outside India, may keep varying based on your circumstances and needs. But what you could do is that the documentation about either shares that you own, mutual funds that you own, and had invested while you were in India, immovable properties that you owned while you were in India. Firstly, the documentation on all of this has to be spotless. You need to ensure that the source for these funds were clearly established. Otherwise, what may happen? You may want money outside India. You sold some of those or liquidated them, and you get stuck in the banking channel where the banks don't allow you to move that money outside India. So therefore, you'll have to ensure that you'll have to take some time out annually, uh, consult tax consultant in India, and ensure that your documentation is up to the mark. Second, file your tax returns in India. You may be having some passive incomes like dividends and interest and all of that. Don't neglect by non complying. Make sure that your compliances in India are up to the mark, because when certain monies get accumulated in your bank account and eventually you want to transfer, if that amounts are already tax suffered and clearly declared in your tax returns in India, the breeze at which you can do that becomes a lot more simpler, and the speed at which you can take the money out becomes higher. Second. Third, have a good rapport with your banker that is there in India. Consult them regularly. Check on your bank accounts. There are a lot of digital frauds that happen, and some of the frauds also happen in non-resident accounts. And in my practical experience, I've seen in some of the non-resident accounts in India frauds taking place, where mobile numbers were changed, monies were moved out, etc. Keep a tab on your bank accounts in India. Have a good rapport with your relationship manager, with the banker in India, to ensure that you keep a tab of what is happening in your bank account. Lastly, whenever you sell a property, you have the option to make sure that the monies are directly credited to your overseas account. But for that, the buyer has to do a lot of compliances. The buyer has to make sure that he does documentation to prove that this money you are adequately paying taxes, and this is out of your repatriable sums of money, etc. So typically what the buyers will say, hey, I don't want to go through all that hassle. I will give this credit only to your Indian bank account. When I say Indian bank account, you'll have to understand it is only your non-resident ordinary account. NRI account is akin to, similar to your foreign accounts, your the country where you stay, the accounts in that country. Therefore, typically the buyers will credit the amount into your non-resident account. Once that happens, they might have also withheld taxes. To understand about what is withholding, how it works, and all of that, both in buy and sell scenarios, you can watch our previous two webinars. You'll get a detailed understanding of that. There might be withholding that has happened. Don't presume that once taxes are withheld, your obligation as far as taxes in India are over. It's not, it's only partially done. You will have to file your tax returns and ensure that those records are also adequately maintained. With all of this, and by keeping a tab on what is the source of that money, you can match your financial needs outside India, because the limits of 250K and $1 million applies in different scenarios. You will also have to keep that in mind, and then based on that you can plan your financials. So to summarize, good documentation, proper tax compliance, and good rapport with your banker, and being aware of the provisions and having a great consultant on your side is going to make your remittances outside India a lot more easier.
Yeah. Thank you, sir, for your practical insights and pro tips for NRIs. Like mentioned in the beginning of this webinar, repatriation is not an afterthought or post-sale banking formality. Rather, it's a regulatory outcome that is decided at the planning stage itself. Like Sir highlighted, it starts from the way property is acquired, choice of accounts, and the documentation trail that is maintained and built over a period of time. And as always, early planning and informed decision making are the strongest safeguards for NRIs for cross border property transactions. With this, we have come to the end of today's webinar and the series on NRI Guide to India Property Transactions. And we hope the session was helpful. And thank you all for joining us, and stay tuned for as we come up with similar interesting topics in our upcoming webinars. Meanwhile, if you want to know more, you can always visit our website, read our blogs, subscribe to our newsletters, and stay updated with key finance insights. Thank you.
Thank you so much. Have a good evening, all of you.